Hi there, my name is Eric Bennis. I'm one of the financial consultants here on the team at John Graham & Associates. Today we're going to be talking about the fact that bear markets come and go. If you've been watching the news lately, you might have been hearing the terms bear market and in the past, possibly bull market. So those are two terms that we're going to define a little bit here and also talk about how to navigate that. So just a little bit ago, the longest bull market in American history actually just ended. It lasted 11 years. And a bull market is when the market is rising, and a bear market is generally when it's falling, such as it has done since coronavirus. So as we all know, coronavirus did change a lot of things in American life, and one of those was it brought up certain economic difficulties, and it did end that record long bull market. Now, there have been 10 different bear markets since 1950, so this is actually nothing new. Even though it plays a lot in the news and you're going to see it all over the place, this is not something that we haven't seen before. So 10 different ones since 1950, and we've always recovered from each one of those, and there's every expectation that we should recover from this one as well. Now, if you are watching the news and you hear them say something about this bear market, and you might think, what does that actually mean? So a bear market is typically a 20% or more decline in the overall stock market. And a bull market, which is the exact opposite, that's when the market's growing, that's going to be considered a 20% or more growth from the low point in the prior bear market. Now, some really good news is that bull markets actually tend to last a lot longer than bear markets do. The typical bull market lasts a little under about 2,000 days, which is about 5 years. So that's 5 years of solid growth for your investment accounts, your 401k, your IRA, whatever else you may have. Whereas the typical bear market actually only lasts about 430 days. So you have to be patient for a little bit over a year there during those typical bear markets. Another piece of good news is the fact that bull markets typically have much bigger gains than the losses that people experience in bear markets. So in the end, we do end up ahead. So the typical bull market, historically, you've seen about 172% gain during those cycles. Now, when a bear market hits, about 34% is the average decline that people experience. So in the end, you do end up in the green. You lose a little bit, but you gain quite a bit. Now, one good thing about bear markets is that when asset prices are falling, those are fantastic buying opportunities. So if you have cash to deploy, then when something is, let's say, at a 30% discount, if you were going to the store and something was 30% off, you think that's a great deal. Same thing with the market. When things are down, then we can buy them for cheaper than they're really worth and wait for their prices to come back, as they always do during those bull markets. So again, we view bear markets as great opportunities to get invested. It's a great time to deploy cash or anything else that's not making money for you. And buy something while it's on sale, essentially. One thing that I want to really hit home is that we don't want to allow fears for the short term to derail your long-term goals. So when you sit down with a financial consultant, such as somebody on our team, and you sketch out what does the next 5 years, what does the next 10 years look like, what do I want for retirement, we put together a plan together that accounts for these types of ups and downs in the market. There's always the assumption that there will be bull markets and there will be bear markets. And a well thought out financial plan with proper diversification and wise asset allocation is going to be sufficient to get you through both the ups and the downs and to help you arrive at your goals as you originally intended. And one last thing that I wanted to leave you with is a neat little tool that some financial professionals use in order to at least estimate where your portfolio may be in the future. Now, this is not obviously a mathematical law, but it's a great estimating tool, and it's called the Rule of 72. So essentially, you take 72, and then you think to yourself, what is my expected rate of return? So let's say you think, based on my risk tolerance and my portfolio, the way it's allocated right now, we can expect basically 8% returns. So 8 goes into 72 9 times. 9 would be the expected length of time for your portfolio to double. So if you have 100 grand and you're making 8% on it on average year after year, then you can expect to have about 200 grand-ish in 9 years. And that's just something that I think is important to kind of keep in the back of your head, especially during a time when the market's down and therefore your portfolio might be down a little bit too. But overall, you can kind of expect that continual compounding and doubling of your monies to continue. Now again, the rule of 72 is an estimation, but it's a great way to kind of combat those behavioral fears that you may encounter if you watch the news during the bear market. Thank you so much for joining us today. Check out more videos like this one on different topics at Invest with JGA on YouTube. And then also check us out on our website, which is investwithjga.com. Thank you so much.